Welcome everyone. Welcome to this Market Thursday, September the 23rd. It's 8 p.m. here in London. As always with those webinars, quick disclaimer: this is not investment advice. So this is purely for information, and I do not take responsibility for losses incurred by viewers. So please do your own research before doing anything. So today, quickly, my background. Started in 2000 as a cash equity trader in Paris, moved to London in 2004, worked for a hedge fund for 4 years, then started to do prop trading from 2008 to start of 2018, took a break from the market for 2 to 3 years, did the mentoring from 2014 onwards, launched in 2019 the 4x4 video series, and doing as well some mentoring. Good evening, Kevin. So today, what are we going to be talking about? As usual, we're going to be talking about the situation across asset classes, stocks, credit, commodities. We're going to be looking at the macro, the flows, the seasonality going into the Q4. Obviously, we're going to be discussing the recent S&P sell-off, which I call the Evergrande OpEx. And after that, we're going to be discussing the Fed meeting and a bit of Evergrande and the China. So market sold off over the last 10 days, last week, should we say, on several concerns and technical factors. As always, I'm always looking for catalysts going forward, which are the end of the quarter. So we're going to see some rebalancing. The earnings season starting in mid-October, and actually even the summer until August was pretty quiet in terms of special situation, but we have much more special situation in the months of September. So talking my portfolio trading was pretty boring for a couple of months. Now it's picking up again. We had some nice special situation spin-off in Europe with Vivendi, UMG this week, Continental last week. We got the OpEx, obviously the rebalancing. So many special situation active trading. So let's start, as always, with the asset classes performance year to date. Similar picture to what we had a couple of weeks ago. Stocks for the new joiners on YouTube or people that are joining today. Not put the laser, let's put a pen. So these are on the left-hand side for stocks. Stocks have been doing pretty well so far for developed market. Emerging market have been struggling. That is true for China. That is true for EM, which is making where China is making 50 to 60% of EM. That is true for Brazil, but developed market have been doing pretty well. Currencies. So this is this pack. There has been a bit more volatility recently, but still very quiet. We are moving in a 3-5% range since the beginning of this year. Bitcoin up 50%, WTI up 50%, and the gold, which has been struggling actually in this risk on for the last 6 months. Week to date, so prices are as of yesterday evening at the close. So if we take into account today, we are back to square one on the S&P almost. But week on week, from Wednesday to Wednesday, we had we had some kind of a sell-off, which we're going to discuss later. No more than 5% at the max for the S&P, but that represented roughly, as of yesterday, 2 to 3% for many indexes. The dollar strengthened versus the other currencies when obviously there is a risk off. The king dollar is coming back in forth, and Bitcoin, which really didn't make the job, which tells you that there is a lot of leverage in Bitcoin, and when everything is selling off, Bitcoin has been following recently. Now into the sectors, left-hand side, again, you know the picture, which is energy, financials, real estate doing very well. On the week to date, more interestingly, anything that was cyclical and got exposure to China suffered quite a lot. We are talking materials, industrials, energy, and anything that had a bit of leverage as well in the balance sheet. There is concern that the credit market, the issues that Evergrande has in China could spread to the rest of the credit market. So by definition, when there is tension in the credit market, some sectors, like sectors which are more leveraged than others, could be suffering, and this is a bit what we have seen. So keep an eye on those developments, and always understand, you know, when you're long or short a sector, if you're long or short a heavy balance sheet. Week to date, similar. So top left hand side. So here this is for the bonds. So the bonds as of yesterday were not moving that much. Today there is a bigger move that when we're going to be jumping into technical analysis, we're going to see that bonds sold off quite a lot today. So yields are up 7 or 10 bips on the 10 years. Why? Because the Fed was more hawkish than expected. So I listened a bit to Powell yesterday evening. And actually, if you were listening to him, he was more hawkish than what the market was expected before. The VIX, we made a high around the 26-27% on Monday or Tuesday, can't remember. Since then, we have been coming back. Now we are at 18 or between 18 and 19%. In terms of top winners and top losers, as always, you're going to have some biotech and some dodgy Chinese names. So FXI, anything that was China, bounced quite nicely from Monday onwards. And the top losers, more interestingly, that is anything that is, again, commodities related materials, Chinese stories like Freeport, US Steel, which was down 15% on the week. So there has been a bit of contagion from the Chinese Evergrande meltdown. Let's go quickly into technical analysis. So here, this is for the S&P. Let's start with the S&P as we have it. So this is the chart. As you remember, we discussed that many times. The S&P, since the rally that started in November last year, kept on bouncing on this 50 days moving average. We went below here. The trend is a bit broken. Feels like we might go, sideways or low, or testing some low again. Market has been strong over the last 2 days. That we're going to see with the OpEx, but technically it's not as good as it was a couple of weeks ago. If we go and look at the VIX again, why implied volatility we get this jump? So we're going to be looking at the same thing later on with the S&P, but the jump that we have. So can I do some circle? Can I do some circle somewhere? Sometimes there's probably a way to do, so let's do this. So here, and so if I do a copy, so if I do here, and here, and here, and here, guess what it is? When you get the VIX jumping, this is when you get the expiry on options. And that always been happening over the last 5 months. So there is a big move on implied volatility, and this is something that I discussed. I think it was a month ago. So if you look at the webinar that we did 4 weeks ago, this is something that we discussed in details. XIC, if you look at the Nasdaq composite. So the gap has been filled now, same with the S&P. We're going to see again what is the aftermath of not only Evergrande, but aftermath of the OpEx that happened on Friday. Russell, because I think this one has been consolidating for quite a long time. And when it's going to go boom, one way or another. So it has been consolidating over this 250 points roughly since March. So that is something really we should all be keeping an eye on, because it's going to be probably moving at one stage. SXXP, which is for Europe, because we get some stock 600. So we are back to the trend. Technically, it's a question is always when we get a sell-off. So if you look at the sell-off that we had here, this is more or less so far exactly the same price action. You get the sell-off, it's coming back, which again happened over the option expiry. Sectors now are a bit more coming down. So this is the Philadelphia Semiconductor Index. This is one sector that I'm really watching. Why? Because I love the cyclicality of this sector. I love the noise that there is around it. I think many market participants are very bullish on that sector. Still, there is some question mark coming in terms of price action, but more importantly on some drivers. So there was some news today on the drum market that prices might be a bit toppish. So I'm looking at this is something that we started to discuss in the community. So I'm looking at Micron, which is coming with the earnings next week. Looking at a potential short here. Trying to find the good risk reward and how to structure the trade. But these are the names that I'll be looking. XLI, for those of you who don't know, this is the ETF for the industrial. So we make a bear trap, meaning we have been recovering from there. Still, it's pretty weakish. And if you do the same versus the S&P, it doesn't look great. Something that we've seen during the stocks that were doing fine or badly over the last week or so is US Steel. So US Steel is now or has been challenging the 21 roughly support. So I'm just giving you some example what I'll be doing for some market leaders, or I should say industry leaders, and see if there is what is the price action telling me. If we go into a regular chart for Emerson, so Emerson is a good proxy for electricity in the US. I think this trend is broken. Euro dollar, quickly let's jump into FX. Euro dollar, we didn't make lower lows, so that is so far positive for the euro. But we are still navigating around this 118, 119. A lot of noise, again, 6 weeks or so around this 118, 119. So if you started your career as a retail trader trading FX, you know now that trading FX is almost pointless, and you should come with us and be trading more often stocks which are offering huge opportunities and many names to trade. Turkish lira, because today there was the central bank that cut rate a bit. Interesting level. So everyone is probably watching the same level and having a lot of stop order around this 880. So this is the level to watch. Is it going to come overnight? Australian dollar, the Aussie dollar, I think the way is still actually coming down and testing the 70. Why? Because China is really putting a brake on everything. Iron ore has been coming down, and I think they want to go and make an example with Australia a bit. Gold, the trend is still not really your friend, and I've been saying that for quite a long time. The trend is still bearish. This way, you get the support at 1680, but it's coming down. I know that most of you started with FX or trading gold. The new generation is trading Bitcoin, but drivers are not that great. Copper, and then we're going to finish with that. We are consolidating. Watch for those levels if it goes higher. If it doesn't, the way is down. Let's go back into the slides. I've been quick because I think we get so many things to cover today that I want to be quick on the following. So a bit of macro as always after the price action. Housing market. So we got the building permits yesterday, which bounced quite nicely. There was on the tape, was it Lena or Toll Brothers? I can't remember which one, saying that they are still facing supply bottlenecks for the next 3 to 6 months at least. But we should go back to seasonality, and we had a nice bounce for the building permits. So housing market is not going to crash tomorrow. Question mark now is, as I said 5 minutes ago, looking into catalysts. We got the earnings season starting in mid-October. And as always, the market coming into earnings is actually moving before that, expecting higher earnings and a good bit of earnings. So if you look at the 4 earnings season on average, I think the beat were between 75 and 90% on both the top line and the bottom line. Now, what we can see from this chart is, so here, this is up, that it's a bit toppish. So there is a question, if you want the market, the S&P normally to go higher, if everything stays the same, you want higher earnings, you want earnings growth. And earnings growth means that the S&P normally should go higher. Question now is really, have we reached the peak in terms of earnings and the upgrades of earnings? So the next months or the next 2 months will say, but over the last months there has been a peak in the earnings expectation. Another thing that I want to discuss is quickly before going into other topics is the equity flows. We know that equity recorded huge inflows this year. Okay, so if we look at this chart from that period, this is huge inflow. Having said that, if we go into the next slide, what happened is recently during the OpEx, we get outflows, and we get exactly the same outflow in June during the OpEx and the same outflow in March of the OpEx. So again, for option expiry, March, June, September, December, and Friday and Monday we got some outflows. So which probably there is a lot of explanation technically. So it's not necessarily natural drivers, but this is something to keep an eye. If the market has been very strong based on new inflows. If there is no quickly inflows coming into the market, then the market could be on a standstill. Seasonality. Why are we talking seasonality? Because we are coming into Q4. So if you look at this chart, that is pretty interesting. So this is based on equityclock.com. And I have the same on Bloomberg. But guess what? The market made a top in September, similar here. So this is based on 20 years of average of the S&P, has been coming down. So if we think where we are now is right here. So sorry, because my drawing is a bit rubbish, but you get the idea. So we could be moving sideways then, as always, are we going to have this end of the year market rally? That is the big question mark. And why is it starting now around October? Is because October, this is the start of the earnings season. So the earnings season very often is very good for Q4, that quarter, which is Q3. And then we get the expectation for the new year. So index seasonality sideways for the next month or so, and then a potential move. Here you get exactly the same story, which are the average for the months. So September very often is a bad month. October is better, and November really, really good months. But as well, October, you can have some volatility, meaning hedging might make sense, especially if the VIX come a bit down even more. So the recent sell-off that we had in the market, and again, recent sell-off is just 4 to 5%. So for the new generation of traders, when the market will really sell off by more than 10%, I think everyone will be struggling to trade this new market. What is interesting is always around this option expiry, at least for the last 5 to 6 months, the market has been selling off, and market participants are trying to find reason. And today, or at least this week, this was this Evergrande and the potentially Evergrande issues spreading to the rest of the world. I think to me it's more, there's a lot of technical. That doesn't mean that we should not look at Evergrande, but there is a lot of technical reason for this sell-off, which is the OpEx. So sell-off, option expiry due to option expiry, the scare on the coupon payment for Evergrande that actually made this payment today, plus the Fed meeting. And finally, some CTA positioning. So CTA stands for Commodity Trading Advisors. And what happened is when we reached the 43.80 on the S&P, as those CTA were pretty long, they had to cut position. On the S&P recent sell-off, so I don't know if you remember, but similar to what I said before, 2 webinars ago, a month ago, we discussed the price action of the S&P around the expiry. Okay, so that because I'm a bit lazy, I used the slide from the previous from this previous webinar, and the chart afterwards went literally like this, and then we did that. And guess what? The expiry was around here. Okay, so what happened again? Around this expiry, the market is selling off. Why? Because the market makers can and have to reset their position. What happened on Monday is the market started to sell off because the market makers were short gamma, and when they are short gamma, what they need to do is selling the S&P. So it goes, and then, you know, when it starts to bounce, then they have to chase on the way up. So actually, as they reset their book and their exposure from Friday starting Monday, this move is always kind of steroids around those option expiry. But you can see that the chart is always the same, which is, let's say the pattern, boom, 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 boom. And here we only had, let's say, a bigger move than usual because the expiry was much bigger than usual. That is a quarterly expiry, which very often creates more flows around that period. But to take everything into perspective, this is another slide because I'm lazy, but that is updated on the drawdown for the S&P year to date. And as I said before, we only went down 4% close on close. So we bounced by 1%. When was that? On Tuesday. But worst case scenario, we're down 5% from the high. So if you think about, you know, potential drawdown that could happen normally on the S&P every 12 months, we are talking, you know, between 10 to 20%. At the moment, we are only down 5%. So please don't say, you know, this is a huge sell-off. This is just, we are at 44.50 on the S&P. We are like 3% from the all-time high. So clearly, this is a bit of a sell-off, but 4 to 5% is pretty small looking at the big picture. Moving into what happened yesterday, the Fed meeting. I always love to start with the balance sheet because that tells you how big the Fed has been yesterday. Over the last 18 months. So yesterday, Mr. Powell came and made his pitch. Actually, I don't know why they didn't started to do a taper from yesterday. So at the moment, what do? The Fed through QE is purchasing 80 billion of treasuries and 40 billion of MBS. And what they told us yesterday is they're going to be starting to taper everything from November. And the target is to end in QE in mid-2022. So that gives you roughly 7-8 months. So roughly you're going to have 10 billion less QE every month. And in the meantime, expecting a first rate hike at the end of 2022. So on one hand, they were saying that inflation was still under control, even if it was shooting a bit higher than the 2% at around 2.2, 2.3%, it was fine. And the job market was healing. So funny thing is, on one hand, Powell said, it's fine. I'm not going to be looking necessarily at the next NFP. I already made my decision. It's not going to change anything. We're going to be doing tapering. And on the other hand, he said, we need to wait a bit just to see. So very weird comments. Having said that, the Fed chairman was more hawkish than what we were expecting before. And this is what we're going to go here. The euro dollar now. If you don't, go into the several webinars that I've been doing and that are on YouTube. But if you look at the expectation that we had a couple of weeks ago, which is the euro dollar for December 2022 here versus what we had as of yesterday, not that many changes, but still, we're going to have probably a 25 bips. I mean, the market is expecting 25 bips rate hike in the next 12 months, in December 2022. Now, if you look at the December 2023, we went from 99 to 98.89. So the market is expecting the Fed to be more aggressive in hiking rates. So if you compare the EDZ2, which is this one, with the EDZ4, so that will be December 2022 versus December 2024, you get roughly 160 bips. So more or less, the market is expecting 6 to 7 25 bips rate hikes. There's always a question mark because, that is a long time for the Fed not hiking rates, and they keep on delaying. They always find new reasons to not changing their policy. Actually, maybe you read the headline from the ECB saying that they keep now kind of QE open, which is another way of saying, this is QE infinity, and if there is one reason to do it, we'll have to do more. And so it feels a bit endless. So this is for the Fed. Actually, what I should have discussed before, let's jump quickly into this chart, looking at the US 10 years, because I think this is important. So you can see the move that we have to do from 130 to 141%. So interestingly, the market yesterday was pretty quiet on the US 10 years. Now it's bonds have been selling off. Same for the bonds. Why? Because I think that the market has been digesting the idea that the Fed is more hawkish, and as well that actually inflation could still be there and more than what the Fed is expecting. So if you bull and bullish stocks, I think you should really keep a close eye to on bonds, because if we start to have a quick move on, I'm thinking yields, meaning a bigger sell-off in the bond market, it will have implication for the equity market, similar to what we had 3 or 6 months ago. On top of this, the bonds have been trading sideways for the last 2 to 3 months. So if we have a move, and the volatility was pretty low, so keep an eye on this, because the move from today by 10 bips from the 10 years is pretty big. So Evergrande China, probably you read a ton of story, and I don't want to pretend to be a Chinese specialist. So, and I know that you get many Chinese specialists in the world. you get many people that make a feast every day to tweet about China and say, you know, look at those commies and look, they are the worst people on earth. This is really not the point. The point is about, you know, understanding what has been happening. So here, this is the chart of Evergrande. So listed for since 2009, a long time. And you see the move where we went ballistic here. So that is the big picture. And now guess what? We are back to square one. So if you have been a market participant for more than 3 years, you heard about Evergrande long time ago, and it started literally 10 years ago, or a bit less, from Citron Research, one of the short sellers, which is no more a short seller, but they were discussing about it long time ago. And actually, if you think about it, Citron Research was banned from the Hong Kong market. And at that time, the market cap of Evergrande was 9 billion. Even a stupid guy like me knew about it for quite a long time. So if you look at 2017, this is one of my first tweets. I knew that China, Evergrande was something wrong. But more interestingly, if you look at a couple of months ago, so this is for the community, the question with all those bubbles is we can identify them. What is really important is you're going to have your top watch list, and you're going to have the names that you're going to be looking at every day. But as well, somewhere on your screening, you're going to be following names that you know could be some red flags. Okay, so a couple of months ago, when Evergrande started to move quite a lot, I knew that as a market participant, you know, there was that the odds of something happening were going on the way up. Okay, so my job, and this is why I enjoy building this community, is to tell to the different subscribers, you know, guys, look at Evergrande, something is coming. That was a couple of months ago, and then now everyone is talking about it. So what is Evergrande? You know, this is huge home builders in China. Again, I'm not a specialist. What I find more interesting is the size of the balance sheet. So they are running 2 trillion Chinese yuan liabilities, which makes 300 billion. So think about it, 300 billion. That is quite significant. So the thing is, I think is in 2018, the CCP, the Communist Party, really decided to change the business model of China. You like it or you don't, that is not the point. They wanted to move from depending mostly from external demand and from leverage business to a more long-term picture. Maybe it's going to work, maybe it's not going to work. But there has been some change over the last 2 to 3 years in China in terms of business model. And for the Chinese Evergrande, that is huge company. You probably know about it now. But if you look at the numbers, we are talking like insane numbers. 2.2% of the Chinese nominal GDP. And if you think that China is making almost 20% of the world GDP, that tells you about the size of this company. That's literally 40 bips, potential 40 bips of the world GDP that could be struggling. And we know that a lot of the world GDP growth was coming from China over the last 20 years. That was a big engine of the growth. So if we go into the next slide, we can see that as well, the M2 from China has been coming down over years. So there is less money coming into the system. And we knew something that we discussed from the start of this year, that the Chinese governments were putting less money into credit, that they were trying to reduce the level of leverage potentially. And guess what? 6 months after, Evergrande has been struggling. The question now is, and there has been some news today that on one hand, you know, they will pay back, and on the other hand, that the CCP is keen on letting this unfolding. Looking at the size of this company, there is a risk that it could be ugly. I'm not smart enough to tell you by how much is going to be ugly, and more importantly, who owns credit in those names. But if we think that the sell-off was mostly on Evergrande, I don't think. Again, the sell-off to me is mostly OpEx related. It's nice to put a story behind it. Now, looking forward, we know that each time that we're going to have a significant news on the name, it's a kind of risk on, risk off for the market. So all the property developer bond prices. So here, this is from an article from FT Alphaville. So if you're not on FT Alphaville, you should be joining. They have good articles. As always in situation like this one, it's the risk is on credit. So the funny thing, if you are a stock trader like me, a stock portfolio manager, you know from the beginning that you are supposed to be the stupid guy, and the credit guys are the smart people. Having said that, if you look now at the leverage that is around credit, I'm not sure that the credit guys are that smart, but literally the contagion risk is on the credit, not on the stock. Why? And that's something that I discussed many times. That's very similar to when some educators are telling you, oh, the market cap of this company is X. The market cap of the company doesn't really matter. What really matters is the EV, meaning you put the market cap plus the debt. So that means you take the enterprise value. What you want to understand in the situation like this one is what is the credit situation. If we look at Evergrande, we know that they have 300 billion liabilities. We want to know several things. What is the size of the balance sheet? What is the capacity to pay back the debt? What is the interest coverage? What is the EV divided by EBITDA? And more importantly, what is the debt distribution? What is debt distribution? Means when the company needs to pay back some of the interest or some of the principal. And we know now that the whole space in China is feeling on the contagion, and the credit for those names has been really struggling. So you get names that are now trading between 20 to 40 cents on the dollar. Evergrande was trading, I think, today on 30 cents on the dollar. So that tells you the market is now pricing high probability of default. And here, this is for the interest payments, something that I just mentioned. Again, if you do stocks, if you do companies only, what you should be looking at is the debt distribution. So look at what is the balance sheet, how much debt they have on their balance sheet, and more importantly, when is the debt maturing. I give you an example. If you get a company that's got 20 billion worth of debt, but the debt is maturing in 5 years' time, it doesn't matter as much as a company that's got the same balance sheet, but with debt maturing in the next 6 months. Why? Because if the credit market closes off, if there is some tension in the credit market, then that can be an issue for them to pay back this level of debt. So look at the debt distribution. I think the story of Evergrande will make the headlines every single day now. Really, we need more to be looking at the potential spread, or let's say, risk of contagion for the other markets. So again, I'm using FT Alphaville, which used actually a research from Liberum, and where we know that China is making 40 to 70% of the global commodities consumption. So if China is really slowing, you can make sure that the commodities will be struggling. So that is the easy one. And then you can be thinking about, what is the second derivative? What about Australia? Australia, which is massively exporting, for instance, to China in commodities, will be struggling. So you can start from the country, you can start from the sectors level, then you can be looking at industries and companies. If you look at the Chinese total commodity supply, that makes 40% of steel flow, 40%, 20% of copper, 15% aluminum, 15% zinc, 10% nickel. So that is pretty big. You can obviously go for all the names like BHP, Rio Tinto, but not only. You're going to have the second derivative and the third derivative and so forth. So the more important thing is the Chinese properties market is making 5 to 20% of the global commodity supply. We know that there is the issue now with China is you get many dead cities where they build tons of buildings where no one is in. That makes everyone smile for many years now. That tells you that the growth that we had over the last 10 years is probably gone. But that tells you as well that companies in Europe, in the US, that benefited massively. And we are talking, companies that are providing services to the companies like I'm thinking, companies that are doing the elevators, like the Kone of this world, of this Otis of this world. All those names will be struggling as well, because that means construction in China is really slowing. And there are many names that are close to their all-time high. So in terms of risk reward, you get potential very good trades. That doesn't mean that the market will collapse, but that means for exposure to those countries, to China, that's going to have an impact. Here, this is the price of iron ore. That was a couple of days ago. It bounced back a bit, but you get the picture. This is for BHP, for instance. We go here and we go back. So if we go into the next slide, did I put BHP? Yes, so BHP up. There is a good chance that it's going to go there. And if you look at the cycle of commodities, it goes very often like this one, where everyone is, when we are around this level, everyone is really bullish. When it starts to go down, people will tell you, oh, but look at 2023 numbers, on EV, on EBITDA, on P or whatever metrics you'll be using, it's super cheap. But the reality, when the music stops, it stops very quickly. So be careful on those names. They are known to be traded by punters mainly. I'm not a big fan of trading those, and I find it pretty hard. But bottom line is be careful on this Chinese exposure. Again, I'm not a specialist, but what I know is, and you don't need to be rocket science, that over the last 20 years, the world massively benefited from this Chinese growth. And I can give you names like, the German automakers, BMW, which were selling cars at 100,000 euro instead of 50,000 euro. I can tell you about, software companies. I can tell you about construction companies. So if there is a slowdown, and if really the CCP decides to put a hold on this leverage and construction mess, then it's going to have ripple effects. Quickly, what we can do together, if you want to, there is no obligation. So you get, if you do the 4x4, if you do the mentoring, you're going to have access to the trading community. So now we get 70 plus traders. I'm trying as much as possible to be very active, to bring new ideas, and people are very nice. I think it starts. It's always about building the community for me, because I know as retail traders that you might be struggling if you're on your own. And when I say to people, I want to build a community and do something, this is more than words. So I hope that it's going to get better. 4x4 video series. This is, you can go on the website, have more description, understanding what it is, and the mentoring, which is for more advanced traders. And this is it for today. I think I talked very quickly today. I don't know why. If you have any question, maybe 1, 2, 3 questions. Otherwise, that's it for today. So if you have questions, maybe the best way is you send me an email at greg@duponttrading.com, either on what we discussed today, or the 4x4, or the mentoring, or the community. And look at if we're going to have the same pattern as usual, which is sell-off in the market, then sell off, sorry, over the option expiry, then bounce, and then follow up and going higher. Question from Rika on my take on the overspending of the US government. I think this is a very good question, which is something that I discussed webinar before, which is the market, as the world is restarting, and as we're going to have elections, so we're going to have the outcome. So, sorry, something that I should have mentioned in terms of catalyst. We get the German election this weekend. So for Europe, this is quite important, and that could have impact on utilities and some other sectors from Monday onwards. But to come back, we're going to have election. Many countries have been running 10-20% deficit. Okay, when I say 10-20%, that is deficit versus the size of the GDP on an annual basis. And as you know, those things it was easy to sell and to do it over the last 18 months because many people were struggling. Now that the world might get better, it's going to be harder to justify those kind of deficits, and that's going to be and we are coming from a high level. So if Rika, you're talking about, you know, this threshold or this debt limit that you get in the US every 18 months, this is pure US politics, and it's making the headlines. And, you know, this is, you know, I think as a retail trader, you could be losing money. At the end of the day, you know, this threshold should be fine. This is always the same question. But in terms of deficit, then you get a problem. Again, I discussed that during the previous webinar, which is countries will need to find money back. Maybe we are all gonna follow the Japanese position, which is running 300 to 400% deficit, debt to GDP. Okay, so that gives us actually 200% room for the US, which is 40 to 50 trillion. So that makes a long way to go. But if we don't, actually, we need to find money somewhere. And this is why, you know, the Trump administration, the Biden administration has been pushing for some higher taxes because, you know, if you give somewhere with the infrastructure plan, you need to find money. So is it taxing the rich? It's always been a big joke because it never happens, but maybe it's going to be taxing companies, maybe not. But yes, money needs to be found somewhere. Will all this investment will push markets higher then? That's a tough one because if I say yes, the last 18 months were characterized by tons of liquidity. We know that central banks, at least they started to say they're going to withdraw some of this liquidity. So if you withdraw a bit of liquidity, it goes hand in hand with risk, a bit of risk off. Okay, what I found very interesting from yesterday is actually more than all the bullshit about inflation and so forth. I think if you look at the GDP expectation from the Fed, I think it was from 2023 and 2024. Yeah, we are talking 2.5 or 2% GDP, which is very, very poor. If you think that the US GDP of the US is growing by 3% on average or 3.5%, very quickly we're going to come below the average growth. So that tells you what I think similar to if you look at the XLI, which is the ETF for industrial versus the S&P, my conviction is we only experience a bounce from the bottom, but this is not a new economic cycle. I don't believe at the new economic cycle. If we had a new economic cycle, you will have the Fed expecting for 2023, 2024, 2025 more than 3% plus. Whereas 2%, you know, it's just inflation. It's nothing really interesting here. Yes, I mean, for the Los Angeles, for the bottlenecks, I mean, it's not only in Los Angeles, it's everywhere in the world. We get bottlenecks here in the UK, where actually there is no drivers. So the question is, are we going to have food for the winter, for Christmas? Are we going to have gas? And actually, if you go shopping, you realize in the UK that half the shelves are pretty empty. So I think there is the supply chain issues is explaining a lot of the non-capacity that is non-met by the economies. And that's the same with the unemployment or the job market in the US. You get 10 million jobs that are offered and no one is taking them. So literally, instead of being at 5.5% unemployment, we should be at 3.5% unemployment. And I think this is why Powell said yesterday, if I was really listening to and being honest with myself, they should probably reduce QE very quickly, and they should have done it yesterday. So many bottlenecks. If you look at the PMI today in Europe and in the US, so the pre-PMI, they were lower than expected, lower than before, because again there is bottlenecks production. So world is feeling the pain. It's true as well for the chips, for the many components are missing. But I don't think, and I might be wrong, but I don't think this is a new long economic cycle. Otherwise, the expectations, the perspectives from the Fed would have been higher. So it really now is, and it's the same with Ricard, similar question, if we reach a top in terms of earnings, it's going to be hard for the S&P to go much, much higher. And we discussed that, I think it was in July or August. There is a question mark of S&P margins, operating margins for companies. Have we reached the top? If we reach the top, then that means as well the EPS might have reached the top. So a lot of those questions will start to be answered from mid-October onwards. In between, there is a lot of unknowns. The drivers, as the market has been driven by these technicals, these options. Again, if you don't know much about options, if you don't know much about gamma exposure, about market makers, about repositioning, about open interest, all those things, you should get better. There are some good guys on Twitter that are explaining that in a very nice way with not my French accent. So that could be a good thing as well for you. Again, I hope it helps. I'm going to try to do the same in a couple of weeks. If you get questions, come back to me. If you like what you've watched today, please let people know. Give me a small like. This is always a good thing. That keeps me going. Thank you for joining. Have a good trading day tomorrow and see you in 2 weeks. Thank you. Bye-bye.